So good morning everybody. Today is our April webinar and we're looking at the new AASB 9 financial instruments and specifically focusing on the impairment requirements in the new AASB 9. You will remember that last month we also looked at AASB 9 financial instruments, but we focused on the categories of financial assets. So today, impairment requirements. So this outline of this webinar, I've divided it into 4 parts. First of all, I would like to look at some existing guidance around impairment and also then the rationale for change. So why do we have new impairment requirements in the new AASB 9? In the second section, I would like to look at the general 3-stage approach and also show you an example. In the third section, I would like to look at the simplified model, which could be used for trade receivables, and then right at the end, a recap of the session. So by looking at this outline, you'll see that I'm not trying to do all the details around impairment requirements. It's a complex area. I'm trying to give you an overview of the new impairment requirements. So what do we currently do? Overview of where we're moving to, and if you need further assistance, please contact me. So the disclaimer, please remember that this presentation is for training purposes only and it's not intended to give you detailed technical advice. So the triple threat accounting standards. So this year, all our webinars, and we've got 12 for the year, we look at the 3 new Australian accounting standards. I think from June for a number of months we'll be looking at AASB 15, the new revenue recognition requirements. Today we're looking at the one in red, AASB 9 financial instruments. And later in the year, and also I think in January this year, we've already looked at AASB 16 leases and we'll revisit later in the year. Now AASB 15 and AASB 9, the two of them are effective for years beginning on or after the 1st of January 2018. Therefore, if you've got a 30 June year end, we're talking 30 June 2019. The leases standard is a year later. However, we have found that a number of our clients are saying, let's deal with the triple threat accounting standards in one big bang and get ready for 30 June 2019. So question, as always, why do we talk about AASB 9 now in April 2017 if it would only be included in your financial statements 30 June 2019? The reason, all of these standards will be applied retrospectively. Therefore, even though it will be included in your 30 June financial report, your current year will be 30 June 2019, your comparative year will be 30 June 2018. The beginning of your comparative year is the 1st of July 2017, which is less than 3 months away. Remember, if you apply these standards retrospectively, you'll have your current year, you'll restate your comparative year, and all the changes that happened before the 1st of July 2017, the beginning of the comparative year, will be adjusted against opening retained earnings. Also, if you adopt a new standard, there will be a third balance sheet, and the date of that third balance sheet will be the 1st of July 2017. So that's the general requirements around new standards as outlined in AASB 108 around accounting policies. So let's look at AASB 139, the current AASB 139, looking at impairment of financial assets. So the existing guidance and why do we need change? Now, first of all, I think one of the big issues around impairment of assets is that we find that a lot of clients and our own partners and staff apply the incorrect accounting standard. So the first thing is to say, if I look at impairment of assets, it will be divided into financial assets and non-financial assets. Financial assets, currently we apply AASB 139, financial instruments recognition and measurement, and if it's non-financial assets, the impairment requirements are outlined in AASB 136. So really, Often we see that people want to talk about, do calculations of impairment of financial assets. They grab the impairment of assets standard AASB 136, thinking that's where everything would be around impairment, and that is actually only impairment of non-financial assets. If you want to look at impairment requirements for financial assets, it's currently covered in AASB 139 and going forward will be addressed in AASB 9. So that's the first and very important thing. Important to note that the two standards will give you a different answer when you do the actual calculation. Also, the indicators of impairment are different in the two standards, so it's important to apply the right standard. So this is currently the situation and will continue to be a problem going forward. Also, currently when we talk about impairment of financial assets, the four categories of financial assets that we have in AASB 139 is on the left-hand side, you can see we've got fair value through profit and loss, we've got loans and receivables, we've got held to maturity financial assets, and we've got available for sale financial assets. So our current four categories. Of these four categories, only 3 of them are subject to impairment testing. Because fair value through profit and loss, it's already at fair value and changes in fair value are already going through profit and loss, so no need to do an additional impairment assessment testing, anything for that category. So currently the categories where we do impairment testing would be loans and receivables held to maturity and available for sale. Now currently loans and receivables and held to maturity financial assets are both accounted for at amortized cost, and you have to do impairment testing, and then available for sale financial assets are accounted for at fair value in your statement of financial position, and changes in fair value go to other comprehensive income or a IFRS revaluation reserve. And then there are rules on when would you have to do impairment testing on these available for sale financial assets, and if it's impaired, you remove your reserve to profit and loss as an impairment loss. So currently, the whole impairment of financial assets in AASB 139 are built around these 4 categories of financial assets. So the indicators of impairment outlined in AASB 139 says that at each reporting date, the entity have to assess whether there's any objective evidence that a financial asset or a group of financial assets is impaired. So the indicators of impairment that we've got in AASB 139 is very different to the indicators of impairment in AASB 136 for non-financial assets. So at each reporting date, we have to assess, is there objective evidence, are there impairment indicators that the financial asset is impaired? And if there's evidence of potential impairment, there are certain rules that you have to apply. So if you've got financial assets at amortized cost, so that would be loans and receivables held to maturity, you apply the rules in paragraphs 63 to 65. If you've got a financial asset at cost, you apply the rules in paragraph 66. And if it's available for sale financial assets, you apply paragraph 67 to 70. And remember still the current requirements. So if we look at the impairment indicators for loans and receivables and held to maturity, the 2 categories that are at amortized cost currently, impairment indicators or examples of impairment indicators are, there's a significant financial difficulty experienced by the client or the customer or the other party. There could be a breach of contract, for example, a default in interest or principal payments, or we could be granting concessions that a lender would not otherwise consider because they're experiencing financial difficulty and because we ultimately want to get our money back, we give them certain concessions. So again, that is an indicator of impairment. Or it could be probable that the borrower will enter a bankruptcy or financial reorganization, again, indicator of impairment, or a disappearance of an active market for a financial asset, again, because there's been financial difficulties. Now, all of these are only indicators of impairment and says you have to do an impairment test. It doesn't mean it's automatically impaired. The other one that is actually the one that's been quite problematic under AASB 139, currently still problematic, is the impairment rules around available for sale, and specifically investments in equity instruments, investments in shares. Because AASB 139 currently says if you've got investment in shares and they're accounted for as available for sale financial assets, which, just to recap, means fair value in the statement of financial position, and changes in fair value go to an AFS revaluation reserve or OCI. You also have to consider whether there's an indicator of impairment, and an indicator of impairment would be if that available for sale revaluation reserve is negative. As soon as it's negative, you do an impairment test. And the impairment test for the investment in equity instruments is the investment in shares would be impaired if it's significant or prolonged, if the fair value is significantly or prolonged below cost. So if your original cost was 100, your fair value is now 50. The question, is that 50 significantly below the original cost of 100? Or even if it's 90, is it prolonged below cost? So it's significant below cost, or, very important, or prolonged below cost. Now, there are no hard and fast rules in AASB 139 on when it would be significant below cost or when it would be prolonged below cost. In practice, we've been using, more than 20% below cost. We would think it's significant. Prolonged more than 9 months below cost, we would think significant. Less than 20% below cost, judgment. Less than 10% below cost, we don't think it is significant. But those are not hard and fast rules. It's kind of rules of thumb developed by the profession over a period of time. Now, a number of you would have experienced some issues around impairment of available for sale financial assets. And to make the issue a bit worse, if your market recovers the next year, that increase in fair value in the next year would be put in the revaluation reserve or in OCI, and it would not be used to correct impairment losses recognized in the past. So it's a little bit of a double whammy. So I thought at this stage, maybe I should ask the question, how many of you currently have investments in available for sale financial assets and then also experience potential impairment issues? So my first poll question for today, if I can find it, now what have I done now? I'll be back. So my poll question, do you currently experience potential impairment issues around investments in shares that are currently accounted for as available for sale financial assets? Just to get an idea, we often have discussions with clients around this issue. It's been around more than 10 years. One of the big reasons that there's a new AASB 9. In the global financial crisis, this was a real big issue and led to a lot of uncertainty. A lot of not-for-profit entities have additional cash that they invest until they need it, and therefore it's actually something that we see in our not-for-profit client base quite a bit. So if anybody else would like to vote, I'll give you another few seconds. At this stage, we've got 70% of attendees have voted, which is fantastic. So let's close the poll and let's see the results. So at this stage, 30% of our attendees So yes, we currently, struggle with impairment or potential impairment of available for sale financial assets. And then 69%, the lucky position, they don't, which is good, 2% unsure. Right, let's move on. So I think, that's one of the big issues currently around impairment, and the way they've addressed it in the new AASB 9 is with the categories of financial assets. And we talked about this in our webinar last month, but I wanted to recap it because it really sets the scene for the impairment discussion today. So going forward, AASB 9 actually has 4 categories of financial assets and still have 4 categories. Currently we have 4 and we move to 4. I have seen that some people talk about 3 categories of financial assets because they treat the middle 2 categories as one, fair value through other comprehensive income. Now, I believe it should be 2 separate categories because the one is for equity instruments and there would be no recycling allowed, and the other one is for debt instruments and recycling would be allowed. So I believe there are 4 different categories of financial assets. So we don't have less categories, which is what they initially promised, but categories that easier to use. And so how does it address your potential impairment issues on investment in shares? On the new AASB 9, if you've got investment in shares, it can either be fair value through profit or loss, and obviously if it's fair value through profit and loss, there's no impairment considerations. It's already at fair value in statement of financial position. Changes in fair value are already in profit or loss. The other option for investment in shares is you can make an irrevocable election on an asset-by-asset basis on day one to treat investment in shares at fair value through other comprehensive income. And what that means is all changes in fair value will forever and ever and ever go through other comprehensive income. Therefore, increases will go through other comprehensive income as well as decreases. And even if you have a negative reserve, you will keep that. That negative reserve will stay there. It would not be an indicator of impairment. No need to do an impairment test. Important to remember, there will be no recycling. So at the date that you sell your investment in your shares, whatever is accumulated in your other comprehensive income cannot be recycled through profit and loss and flush through the statement of profit and loss and other comprehensive income. The only way you can get rid of it is to transfer it directly to retained earnings. So the first 2 categories that we've got here, fair value through profit or loss or fair value through OCI, equity instruments, no recycling, really addresses the current concerns around impairment of available for sale financial assets. The other 2 categories that we've got here are fair value through other comprehensive income, specifically for debt instruments where there could be recycling when you sell the item, and then also amortized cost. So if you've got a debt instrument can either be fair value through profit or loss. Remember, anything can be fair value through profit and loss. That is the approach that actually standard setters would prefer for everything. However, a debt instrument could also be fair value through other comprehensive income, debt instruments recycling, or amortized cost. So what we're going to talk about in the rest of this webinar are impairment considerations and impairment requirements for fair value through other comprehensive income and amortized cost, those 2 categories. And these 2 categories, fair value through other comprehensive income, debt instrument, and amortized cost, those 2 categories only relate to debt instruments. If you've got a derivative, it can't be in there. It has to be fair value through profit and loss. If you've got investment in shares, if you've got equity instruments, it can never end up as amortized cost or fair value through OCI debt instruments. So impairment requirements that we talk about today only deal with the 2 categories on the right. So a little bit more background. So the current AASB 139, the impairment model is called an incurred loss impairment model. So credit losses will only be recognized when an incurred loss trigger occurs. So the experience to date has been that that actually results in impairment losses or credit losses being recognized a little bit too little and a little bit too late. So incurred loss model, we're waiting too late to recognize these impairment losses and too little. The new AASB 9 impairment loss model is called an expected credit loss model. So we're not waiting right until we've got an impairment trigger. We're actually at an earlier stage start to look at the future, look at expected credit losses. It's forward-looking in nature, and therefore it results in the recognition of impairment losses at an earlier stage, number one, and larger credit losses. So it addresses the too little and the too late in that impairment losses would increase, and it brings it forward. Then this would affect the recognition and measurement of bad debt provisions for corporates, and examples within its scope would be trade receivables. Sorry, I didn't do that. I haven't touched anything, but it jumped. It would be trade receivables, third-party and intercompany loan receivables. It could be investments in government bonds, and then issued loan commitments and financial guarantees. Oh, don't know what happened. Excuse me, I'll just try and fix it. The audience view, something's gone horribly wrong. Please excuse me, we're just trying to figure out what's going on. Has it changed? I have no idea. Please excuse me, I'm just trying to figure out what's going on. Is that better? I haven't touched a single thing and my slides disappeared. I'm telling you there's a spook in this place. All right, we are back on track. Let me just move that out of the way. You can see me on camera. I haven't done anything. That's why I'm on camera, so you can see I'm not doing anything. All right, the new expected credit loss model is forward-looking, and therefore it requires a broader range of information to be considered. You can start with historic past experience information. You can update it with current knowledge, current experience, but then also you're supposed to incorporate some forward-looking information. So it's not just past experience, it's also forward-looking. However, why we should talk about it now, if you start to adopt the standard for 30 June 2019, you would need some historic past experience information to come up with an expected credit loss model which is forward-looking. The new model is more responsive to changes in credit risk. So as soon as there's a change in credit risk, it would impact our provision. It results in earlier recognition of credit losses. So it's no longer appropriate to wait for that trigger to happen. We don't wait for a default event to happen. We potentially recognize it a lot earlier. The other thing which is very important, it increases the level of judgment required in order to create a provision for impairment. And as soon as we've got that provision, and again it's jumped, I don't know what's going on. Are you still seeing my screen at least? All right. So key features of this new model. I'm going to put my mouse on a piece of paper. Maybe it's running on the table. Key features. We've got a single model applying to all financial instruments within its scope. So it removes the complexity associated with multiple models under the current AASB 139. And as I've shown earlier, there were different rules for loans and receivables held to maturity available for sale. And also, it requires enhanced qualitative and quantitative disclosures in accordance with AASB 7 that will assist users in understanding how an entity has applied this expected credit loss model and the reasons behind changes in expected credit loss model. And that's what I wanted to say at the end of the previous slide. At the end of that slide, I've said there would be increases in the level of judgment required. Now, as soon as the standard setters give us standards where there's increased level of judgment, the next thing would always be increased disclosures on how you've applied your judgment. And that's what we've seen here as well. So if we look at the expected credit loss model, there are really three different approaches that could be used. There's the general three-stage approach. It will apply to most loans and debt securities, so loan receivables. There's a simplified approach, which will apply to most trade receivables. And then there's a purchased or originated credit impaired approach. So that would only apply in limited situations, we're hoping, where financial assets that are credit impaired at initial recognition has been acquired. So on day one, the financial assets are already credit impaired. So today in my webinar, I want to stick to the two common ones. I want to start with the general three-stage approach, and then I also want to look at the simplified approach, because that would be the two approaches that we would expect to see most often in our client base. So if we go on to the general three-stage approach. Now, a bit of an overview. First of all, initial recognition of these financial assets, and remember it's financial assets that are accounted for at amortized cost or fair value through OCI, debt instruments can be recycled. Only those two categories. Initial recognition is that you would recognize a loss allowance or impairment loss allowance equal to the 12-month expected credit losses. Now, the 12-month expected credit losses are the credit losses that are expected to result from a default event that are possible within 12 months after the entity's, first of all, initial date of recognition or going forward after reporting date. The actual loss does not need to take place within the 12-month period, but we're looking to a default event that could possibly happen within the 12 months. So the emphasis is on potential default events within a 12-month period. Then after initial recognition, there's a stage 1, a stage 2, and a stage 3. So all of these items, initially we recognize a 12-month expected credit loss. So if we look at after initial recognition, the three stages are stage 1. If the credit risk has not increased significantly since initial recognition, then we continue to recognize this financial asset and we continue to recognize the impairment loss based on 12-month expected losses. Remember on the previous slide, we've said initial recognition, we'll look at 12-month expected credit losses. Therefore, after initial recognition, if there's not been a significant increase in your credit risk, we continue to look at the next 12-month expected losses. So we're looking at the possibility of a default happening within the 12 months after reporting date. However, if the credit risk has increased significantly since initial recognition, we would now move over to stage 2 and we would recognize lifetime expected losses. The other thing to remember is for stage 1 and stage 2, your interest continues to be recognized on a gross basis. And I'll do an example very soon to illustrate what I mean with gross basis. Stage 3 would kick in where you've got a credit impaired financial asset. And to determine whether you've got a credit impaired financial asset, you look at the same triggers that are currently outlined in IAS 39 or AASB 139. You'll recognize lifetime expected losses, but the big change in stage 3 is interest would now be recognized only on a net basis. The reason for that, if we know this asset is credit impaired, we do not want to continue to recognize an excessive amount of revenue based on a gross basis when there's this potential issue. So a bit of a decision tree, as you know by now, I love a decision tree. So to me, the first question would be, this is the first question after initial recognition at reporting date, has the credit risk increased significantly since initial recognition? Because at initial recognition, all of us always have to look at 12-month expected credit losses. Now at the first reporting date, after initial recognition, has the credit risk increased significantly since initial recognition? If you say no, you stay with stage 1, 12 months. If you say yes, next question is the financial asset credit impaired? So it's deteriorated or increased so badly that it's actually credit impaired. If you say no, then we're in stage 2. So it's significantly increased, but it's not credit impaired, stage 2. If you say yes, then we're in stage 3. So a little bit of a decision tree of what you could apply at every reporting date. So after initial recognition, to look at this slightly differently, or a little bit of a summary, if you look at the 3 stages, stage 1, 2, and 3 at the top of the screen, there are 2 implications. The one is the recognition of the impairment. You've got in stage 1, it's 12-month expected credit loss. So initial recognition and after initial recognition, stage 1 is 12-month expected credit loss. In stages 2 and 3, we look at lifetime expected credit loss. The other thing to consider is the recognition of interest. Remember, we're talking about debt instruments here. And on debt instruments, we've got potential interest income or interest revenue. If the debt instrument is in stage 1 or 2, we're talking about effective interest on the gross carrying amount. That is before we deduct the provision for expected losses. However, when you move to stage 3, your effective interest rate or your effective interest is now calculated on the net amount, the net carrying amount after you've deducted the impairment loss or the provision for impairment losses. So I've shown you 3 different ways to look at the 3-stage approach. So some people prefer the table, some like a decision tree. If we talk a little bit more around the detail, I've talked about stage 1, initial recognition, and after initial recognition, stage 1. I've talked about a 12-month expected credit loss model, or you're looking at 12-month expected credit losses. So what does that mean? 2 key things that I want to highlight at this stage. First of all, your 12-month expected credit losses are calculated by multiplying the probability of a default occurring in the next 12 months with the total expected credit losses that would result from that default, regardless on when those losses occur. So we're not looking for losses that are occurring within the next 12 months. It is a default event occurring in the next 12 months, and you multiply that with the total expected credit loss as a result of that default. So that is how you come up with your 12-month expected credit loss. It actually represents a financial asset's lifetime expected credit losses that are expected to arise from default events that are possible within the 12-month period. So default events possible within the next 12-month period. If you look at lifetime expected credit losses, it is the present value of expected credit losses that arise if a borrower defaults on its obligation at any point throughout the term of a lender's financial asset. So as soon as there's been a significant increase in credit risk, we're not just looking at what's the possibility of a default within the next 12 months. We now have to come up with what's the possibility of a default in the lifetime of this financial asset. And it's calculated based on a weighted average of expected credit losses. with the weightings being based on the respective probabilities of default. So it's a weighted average of expected credit losses. Now, we talk about a default a lot. And therefore it's important to say what's the definition of a default. So an entity should apply the definition used for its own internal credit risk management purposes. So how does the entity define a default? However, AASB 9 says there's a rebuttable presumption that default occurs when amounts are no later than 90 days past due, unless there's other reasonable and supportable information to indicate a more lagging default criterion. So as soon as it's 90 days past due, we are assuming it's a default. 90 days past due, a default, and that's a rebuttable presumption. So we'll only rebut it in a client situation where there are reasons and supportable information why for that particular client industry there could be a more lagging default criteria. Now, we've done a lot of talking around these three-stage approach. I want to do an example to illustrate the 3 stages. So example 1, I've got 2 examples today, one on the general 3-stage approach and one on the simplified approach. You've got the basic information in front of you, and then after today's webinar, I'll also circulate the journal entries. So example 1, think with me. Bank A lends $100 to Company X for 5 years with 10% interest, and it's unsecured. Now, on initial recognition, so we know on initial recognition, we have to look at the 12-month expected credit losses. So on initial recognition, there's a 5% probability of the loan defaulting in the next 12 months. And if the loan defaults in the next 12 months, it will be 100% loss. So on initial recognition, it's stage 1. The gross amount is 100, and your allowance account that you're going to create on initial recognition is $5. So it's a probability, the 5% of the $100, and it will be 100% loss. So what would the journal therefore be on day 1? So you'll say debit a loan receivable and credit cash of 100. And then on day 1, we look at the 12-month expected credit losses, and we say debit an impairment loss in profit and loss of 5 and credit an impairment allowance of $5, which we've calculated on the previous slide. So this is initial recognition. So already at initial recognition, we look at the 12-month expected credit loss. Then at the end of year 1, we've got new information. At the first reporting date, there is a 0.5% probability of the loan defaulting in the next 12 months, and then there'll be 100% loss. So it looks as if there was a bigger risk of default in the first year. Some loans have the characteristics that if people are going to default, it will be quite soon. So after end of year 1, we say, listen, the probability of defaulting in the next 12 months is only 0.5%. So it's still stage 1. There's no significant increase in credit risk. The gross amount is 100. Allowance account or the allowance provision should now only be $1.50, and your interest earned is still a gross amount, the $100, 10% for the 1 year, and we've got $10. So the journal entries would be, on the next slide, you debit your impairment allowance with $4.50. Remember, impairment allowance is a balance sheet account or an account in your statement of financial position. You originally had it at $5 initial recognition. The end of year 1, you bring it down to 50 cents. And you credit reversal of impairment loss in profit and loss. You also have to account for your interest income, so debit interest receivable, credit interest income, $10. So if we then go at the end of year 2, Company X is expected to have cash flow problems due to a deterioration in economic conditions, and it's actually expected to breach its loan covenants. The probability that the loan will default over the remaining life of the loan is 35%. So why are we now looking at the remaining life of the loan and the probability of default over the remaining life? Because this receivable has now moved into stage 2. There's been a significant increase in the credit risk due to the change in economic conditions. The gross amount of this receivable is still 100. Your allowance account now have to go up to 35% of the 135, and your interest earned is still on a gross amount, so your interest earned would still be your $10. So remember, at the end of year 1, we had a allowance account 50 cents. So what do we do now at the end of year 2? We would say debit an impairment loss in profit and loss $34.50, and we would credit an impairment allowance $34.50. So our impairment allowance is now sitting at $35. We would continue in stage 2 to recognize our interest income on the gross amount. So the $100 gross multiplied with 10% will give me interest income of $10. At the end of year 3, Company X breached its banking covenant. So we now have a credit event or a credit trigger. Bank A estimates that the probability of loan default over the remaining life of the loan is shot up to 60% because it's breached its covenants. So it's now stage 3. The gross amount is 100. The allowance account should now be 60% of the 100. Remember, at the end of the previous year, it was already at 35. And then the interest earned, and this is the big issue in stage 3, now the interest earned would be calculated based on the net amount. So you'll take the gross amount of 100 less your allowance account, your provision for impairment loss of 60. Your net amount is 40. 10% of 40, your interest earned will now only be $4. Remember, year 1 and 2, it was on the gross amount, it was $10 each. Now we've got $4. So it's a big change in the interest earned. So you debit your impairment loss, 25, and you credit your impairment allowance with 25. Remember, at the end of year 2, our impairment allowance was 35. We add another 25. Our impairment allowance is now 60. And our interest receivable and our interest income or our revenue income is only $4. So this is a really good example to step you through initial recognition of what do we do. While we're in stage 1, what do we do? Once we move to stage 2, what do we do? Once we're in stage 3, what do we do? And you can see there's an impact not only on the calculation on the impairment allowance in the statement of financial position, but also an impact on the interest income or revenue that we recognize every year. Now you can see a big issue is the transfer criteria, and every entity will have to apply judgment, consider the nature of their business to come up with triggers for transfers from stage 1 to stage 2 and also transfers from stage 2 to stage 3. Now the standard gives a lot of examples, guidance on things to consider. Some of the things that could trigger a transfer from stage 1 to stage 2 could be changes in the general economic or market conditions, expected or potential breaches of covenants, or expected delay in payment. However, if they actually not paid or they're paying late, that would mean stage 3. That would, so if we wait for that, it would recognize it too late, and that's what we're currently doing. The other thing that's important is there's a rebuttable assumption that your credit risk has increased significantly, which means we have to move to stage 2 when contractual payments are more than 30 days past due. So that is like a backstop or requirement within the standard. Yes, you can come up with other triggers for transfers, but the rebuttable assumption is more than 30 days past due, it has to move to stage 2. So, do you gather the information to determine how many days past due and then follow through on your impairment provision? Some examples of triggers for transfers from stage 2 to stage 3, which will be very similar to the triggers we currently use to recognize a provision for impairment losses, is the actual breach of a contract, so a default in payment, a granting of a concession to a borrower due to the borrower experiencing financial difficulty, or it's probable that the borrower will enter bankruptcy or other financial reorganization. So it's similar to what we currently have. Again, the rebuttable assumption, a default occurs when amounts are, 90 days past due or more. Therefore, more than 30 days past due, we move to stage 2. More than 90 days past due, move to stage 3 as like a backdoor requirement. Before we move on, I thought I would ask you another poll question. So I go to my polls. And the question I asked, do you expect to have many financial assets at amortized cost or debt instruments at fair value through other comprehensive income? And why I'm asking that question is, if you've got items in that category, these new impairment rules would apply to you. So, would you have amortized costs? So we're thinking related party receivables, loan receivables, trade receivables, all of those are amortized costs, and this would potentially impact you. I'll give it a little bit of time. We've hit the 50% of people have voted. Let's see if we can get a few more. I just want to assess how many would be, impacted by the three-stage approach and, have to do a bit of work on identifying the triggers, moving from stage 1 to stage 2, as well as stage 2 to stage 3. So yes, we've got around 70% of our people have voted. And if I share it, you'll see 43% would say yes, absolutely, we have those items and we'll have to consider the three-stage approach. 32% no, and then 25% not sure. I understand that because, we'll have to do a little bit of work on the new categories of AASB 9 to determine which categories you would have. So if we move on, and I just want to check the time. Yeah, I've got about 15 minutes left. If we do the simplified approach or the simplified model, which is allowed for trade receivables, in this model, basically, it says it gives us a 12-month practical exemption. So if you've got trade receivables with a maturity of less than 1 year, now I would say most businesses will have trade receivables and maturity expected to be less than 1 year. Therefore, for you, because it's already less than 1 year, whether you use 12-month expected losses or whether you use lifetime expected losses, it wouldn't give you much of a difference because lifetime expected losses is already less than 12 months. So you could use this exemption, use a simplified model for your trade receivables. You would group your trade receivables based on their due status or other attributes. So you could use geographical region, Sydney, Melbourne, Adelaide, or you could look at different industries. You could look at postcodes. You could look at customer ratings. So you could group your trade receivables and come up with a provision matrix. And that would improve the accuracy of you estimating your expected credit losses. And the provisional rates would not only reflect past experience, current expectations, but should include some kind of forecast of what the future credit conditions would be. So to show you what I mean with the simplified model, let's look at example 2. Now in example 2, we're saying on the 31st of December year 18, company A has trade receivables of 30 million. And the customer base consists of a large number of small clients. And company M estimates the following provision matrix. So it's based on historical observable default rates, but it's also been adjusted for forward-looking estimates. So, expected macroeconomic conditions to exist in Australia, as example, or in the different regions where you operate. So they've prepared this provision matrix where they look at splitting it between your gross carrying amount, which is the third column, the gross carrying amount. Your receivables are split between current, 1 to 30 days past due, 31 to 60 days past due, 61 to 90 days past due, and then more than 90 days past due. So total trade receivables 30 million, and we've split them in different categories. And then based on your past experience, but also incorporating forward-looking estimates, the expected default rates for current is 0.3%, 1 to 30 days past due 1.6%, all those percentages, and it gives you more than 90 days past due will give you 10.6% for more than 90 days past due. Using this model, you can come up with a credit loss allowance, an expected credit loss allowance, which is a weighted credit loss allowance. And that would add up to $580,000 at the end of on 31 December 2018. And you would create that allowance. So debit impairment loss in your profit and loss 580 and credit your credit loss allowance. That's on the assumption before this you had no credit loss allowance. 1 year later, your trade receivables have increased to 34 million. Company M revises its forward-looking estimates and expect the general economic conditions is performing worse than originally expected, and they redo the provision matrix. So you can see your gross carrying amount add up to 34 million. You still have your expected default rates that have now changed because economic conditions have worsened, and then you've got a new credit loss allowance at 31 December 2019, which is now $824,000. So what would that mean? It would mean that the increase in your allowance should be processed as a journal. Could you please look there, 31 December, it shouldn't be 14 and 15, it should be 31 December 18, 31 December 19. Therefore, the movement, the journal entry for 31 December 2019 is debit expected credit losses in profit and loss $244,000 and credit your credit loss allowance. So at the end of 2019, 31 December 2019, you now have a credit loss allowance of $824,000. So I would imagine that most of our clients have trade receivables. And the issue is, do our clients have this information readily available in order to come up with a provision for bad debts in relation to trade receivables? Because we're now looking forward, we're not waiting for the default event or trigger to happen. We come up with an expected default rate, and we come up with a credit loss allowance a lot earlier, and it will be bigger. So if your trade receivables are more than 12 months, so expected to receive it after 12 months, it would include a significant financing component, and this is very similar to the rules we have in the new AASB 15, which talking about if there's more than 12 months difference between the recognition of revenue and the cash flow, there's a significant financing component involved. In that situation, you've got a choice of the simplified model or the three-stage model. Please note that the choice that we're talking about here is not available for intercompany or related party receivables. So if you've got an intercompany receivable or you've got a related party receivable, you need to use the three-stage model. So if you look at intercompany or related party loans, the standard does not provide any practical expedients for intercompany or related party loans. The three-stage model applies to related party loans, and it applies to related party loans and intercompany loans in the parent account and the consolidated financial statements. Obviously on consolidated financial statements, hopefully it would eliminate, or intercompany loans would eliminate, but it would, the three-stage model will have to be used in the parent entity accounts, and if you're not using the 4 columns, it will also be in that parent information that's in a separate note to the financial statements. So we're talking here about loans that you've provided to subsidiaries, sister subsidiaries, associates and joint arrangements, and you need full disclosure of the three-stage model. So this is a very important thing. This simplified approach only applies to trade receivables and not intercompany loans, not related party loans. So if we look at the time, wow, 5 minutes before 12, good timing today. Let's look at a recap of this session. Key messages is AASB 139 has an incurred loss model, and that will now be replaced by an expected loss model in AASB 9. Please note that the new model is not an incurred loss model plus something. It's not as easy. We have to do some modeling to come up with expected losses. We could either use the 3 stages, or you could use a simplified approach for trade receivables. You cannot solely rely on past historical information to come up with this provision. You also have to predict future bad debt losses based on predictions on future changes in micro and macroeconomic conditions. You can apply the shortcut or the simplified approach, the stage 1 12-month expected loss approach to trade receivables if it's got less than 12 months maturity. If it's more than 12 months, you can choose the shortcut approach or the full 3-stage approach. You have to apply the full 3-stage approach for intercompany or related party loans. So if you would like to register for our regular newsletters, some videos that we'll be posting on LinkedIn or on the BDO website, please contact me personally on LinkedIn, email me, or go to this website and you can register for newsletters, videos, or webinars. Any questions, please send them through and I'll look at them, get back to you. I would like to thank you for joining me for this month's financial reporting webinar, and I hope you can join me for next month's one. On the 17th of May, our next webinar is a webinar looking at getting ready for 30 June 2017. So what are the new standards that are mandatory for 30 June 2017? What are the ASIC focus areas for 30 June 2017? So definitely a webinar not to miss. Thank you very much, and I hope you have a good day.